If you want to trade like a rebel, you got to come to RebelCon 2022. It's going to be in Dallas, Texas, at the fabulous Four Seasons Resort. It will be more fun and more live trading than we've ever done before. That's why it's called RebelCon 2022. We're going to have barbecues and double the amount of live trading. The guest speakers, as soon as we announce those, this thing's going to be sold out, limited to 250 people. Sign up now for RebelCon 2022 at the Four Seasons in Dallas, Texas.
Welcome to the rebellion.
And good afternoon once again, Market Rebels. And I hope everybody had a fabulous weekend. And that brings us up to August 1st. Can't believe we're up to August already. We started this back in May, so it's been 3 full months. Seems like we just started it. But if you're new to Trading Tune-Up, it's absolutely great having you here. We do this every Monday, Thursday, Friday, 4 p.m. Eastern Time. And the last couple of weeks, we've talked about different situations with vertical spreads. And on Friday, I talked about a special use of a vertical spread of hedging a straddle. And during that presentation, I said that there's a sister strategy, related one, that's called a strangle. They're so similar that they're usually taught in the same course. You usually see straddles and strangles. But there are some really powerful ways of hedging these strangles. And once you understand these various hedges, they're just going to give you a lot more opportunities, a lot more ideas, and just help you to understand trading much better. So today we're going to take a look at a special case of a strangle called an in-the-money strangle, sometimes called a guts strangle. And so from last week, we talked about the straddle. So remember, this is our risk graph for a straddle. Looks like this letter V. We get our bend right here at the strikes. We would have usually an at-the-money call and put, so this might be a $100 call and put. So we get this pointed bottom down here. That's where the strikes are. But if we do a strangle, same idea, we're going to buy a call and a put, but we will separate the strikes. So we're going to get something like this. So all things being equal, the strangle is going to be cheaper, and that's why this bottom line doesn't sit as far down. Usually can't lose as much with a strangle. But as we've talked about with the risk-reward principles, that also means it's riskier. It's harder to generate a profit, and that's because you'll see that these break-even points are pushed out. You can see that the blue line's a little bit tighter, a little bit closer together than the reds. The reds get pushed out, and that's because we're usually dealing with higher strikes on the calls, lower strikes on the puts. But again, one of the benefits is that we get the maximum loss reduced as well. So it's just a trade-off in risk and reward. Now on Friday, I left a little puzzle that is going to help you to understand the in-the-money strangles a little better. So as a review, this was the question. We have two guards that are facing in opposite directions, yet they can see each other. And I also gave you a little hint. I said, no, there are no mirrors or any kind of tricks like that are done. How is this accomplished? All right, so the big question is, how do they do it? So I hope you put some thought into that this weekend. It can usually be a little bit of a puzzler until you see the answer. And the answer is that they are facing each other. And this is something that people say, well, they're not in opposite directions. Well, yes, they are. Just the fact that they're facing each other doesn't really change anything. And that's really the essence of what changes what we might call a standard strangle from an in-the-money strangle. So notice if we go back to our initial position, where they're facing away from each other. This is the way that most people consider if we said that the guards are facing in opposite directions. So let's say that they're guarding the castle here. The guard on the left is guarding all of the places out to the left. Guard on the right is guarding all the spaces to the right. But notice that means we have this blind spot in the middle. There's an area that somebody might be able to sneak into the castle. However, if we let them face each other, watch what happens. The guard on the right sees all of the space between them plus the area to the left. And the guard on the left sees all the area to the right plus the space in between them. So we're kind of getting double coverage in the center here. So we don't have this blind spot. And this is really the essence of understanding in the money versus out of the money strangles. And if you understand those, they are going to go a tremendously long way into helping you understand other strategies, hedges, rolls, and morphs. So again, it's a very simple principle, but it's going to go a long way. And we'll talk about some of those in the future. So let's start with a standard strangle. Typically with a strangle, somebody is going to use out of the money option. So let's say that we buy an out of the money put and we buy an out of the money call. They've got to have the same expiration, but they will have different strikes. So that's really what separates them from the straddle. So let's say that our stock is at 97.5 and we buy the 95 put. That would be an out of the money put. Let's say it's trading for 3 and we buy an out of the money $100 call, trading for a little bit more for 310. So we would say that you would be long the 95 100 strangle for 610. 610, that's just the total prices that we've paid for these options. So if we did that, this is what we get. We have a max loss of 610. And notice if we go back to our guard analogy, that the $100 call kind of watches or guards all of the prices to the right. Okay, it can capture all of these, with the puts, guard on the left can capture all the prices to the left, and the guard on the right can watch or kind of capture all of the prices to the right. But notice, just like when the guards are, in the first example, facing away from each other, we get this blind spot in the middle. And this is why a strangle can lose the amount that you paid. Because it's possible that the stock closes in between somewhere in this red zone, the 95 puts out of the money, the 100 calls out of the money, the whole thing goes up in smoke. But what if we switched them? And this is where people usually don't think to do this. What if we kept the 95 strike on the left, we kept the 100 strike on the right, but we switched the calls and the puts? So if you joined us in one of the earlier sessions, we talked about a few option pricing principles, and there I said that lower strike calls and higher strike puts have to be worth more money. Now look what you're doing. Now you're in possession of the more valuable strike and the more valuable put. We have what's called a built-in box position. And so just like with the guards, the 95 call sees all of the prices or captures all of the gains to the right as well as in between. And the $100 put captures or watches all of the prices to the left. But we have this area in green. We've gotten rid of the blind spot. And that's why we have a guaranteed gain equal to the difference in strikes. So if we have the 95 call and the 100 put, we still have, for the most part, exactly the same risk graph. Everything, the characteristics are all the same, but we just have this guaranteed zone in the middle. It's also nice for a morph if we want to break it apart. We are in possession of a lower strike call, higher delta call, and a higher strike put, higher delta put. So there's another reason why we might want to structure the profile this way. So to take a closer look, why is this guaranteed to be worth 5? Well, let's take a look at various stock prices. Here's the 95 call, and here's the 100 put. Well, we know if the stock is 85, 90, or 95, the 95 call is worthless. If the stock is 100, it's worth 5. If it's at 105, it's worth 10, and at 110, it's worth 15. The $100 put with a stock at 85 is worth 15. At 90, it's worth 10, and at 95, it's worth 5, and at 100, it's at the money, worthless, or for any stock price above that. So look what happens when we total them. Stock is at 85, I have a call that's worth 0 and a put that's worth 15, worth 15. Stock is 90, I've got 0 and 10 for a total of 10. 95, I've got 0 and 5 for a total of 5. 100, I've got 5 and 0, again, total of 5. Stock is 105, we have a total of 10, and at 110, we have 15. But notice we have a minimum of 5. It doesn't matter what stock price you pick. If you want to pick something in between here, what if the stock is 97? Now your $95 call is worth 2. The 100 put is worth 3. 2 and 3 gives us 5. You can't escape it. It's got to be worth 5 because we've boxed that in. And that is a really powerful strategy that most traders never consider. So let's take a look at an in-the-money strangle. Let's say you're going to buy an in-the-money put, in-the-money call. Again, let's say our stock is 97.5. Now notice that the 95 call is going to be worth more money, right? We saw the put was worth $3. Now it's worth $5.60. The $100 put is also worth more money, and it's worth $5.50. It was previously worth $3. I think the call was $3.10 and the put was $3. But notice that our long 9500 strangle would be worth $11.10. And this is where traders go, oh my gosh, why would I do that? When I can pay $6.10 for the other one, why would I pay $11.10 for this? Because they're overlooking the box. You've got $5 coming back to you. And so if you have $11.10 that you're spending, you're guaranteed to get 5 back. Max loss is $6.10. Look at that, exactly the same as we saw. Now, of course, in the real world with skews, that might be another reason that we would structure it this way in the money. So this is our risk graph, looks exactly the same. Maximum loss down here at 610. But again, we have some potential interesting morphing positions because of the way we've structured it. Because of skews, we might actually get a little cheaper price, might even be able to mitigate the theta, depending on what's happening in the markets and with our skews. But again, this is something that most traders never think to look at. So let's look at an interesting hedge. Let's say we buy the 95 call for 3 and the stock rises. It's really jumped up a lot, like we're seeing right now in a volatile market. It can go down big, it can also go up big. And at a later time, not on the same day, but at a later time, the stock has gone up, so the value of the put has gone down. Now, we saw it before, it was roughly about 3, but now let's say it's dropped to about $1. What could we do? Well, this is where some traders will say, well, I've got a gain, let me just take it. But we're in a volatile market. What if we get whipsawed in the other direction? What if we continue to catapult to the upside? And traders go, well, I don't know what to do. Let me just close it. I've got a gain. Let me move on to something else. Bad idea. Take the trade that you're in and manage the risk. So in this case, what's your max loss? Now, if you talk to most traders, they'll say, well, that's easy. The max loss is the amount you paid. So you paid 3 plus 1, your max loss is 4. Not true. Look at the way that we've structured this. Anybody see that? We have a built-in box position equal to 5 points. So we've spent 4, that's the 3 and the 1. We're guaranteed to get $5 back. It's actually a guaranteed $1, and we're playing both sides. So we're going to go into this. We have a guaranteed gain of $1, but we also have unlimited gains in both directions. And that can be a beautiful thing in a volatile market. And one of the ways that we do that, it's not just with the strangle, but this is a fairly easy example, is to show how we can create box positions. And by guaranteeing these positions, we can get ourselves into some really interesting profiles. Now, for another little side note, a lot of you know about rolling. What if we had rolled the call? Well, rolling the call for $4 would be exactly the same thing as buying the put for 5. Okay, you're either boxing in the points and having to, we bought it for $1, so we boxed in the balance. So it's not really a difference if you pay $1 and guarantee 5, that's a $4 gain, or if you roll for a $4 credit and take the $1 loss of the extrinsic value. There's just 2 different ways of doing the same thing. The difference here is that if you roll it, you've only got the upside gains this way. By doing the in-the-money strangle, I've captured them both. So again, it's just an opportunity that most traders overlook. So there's a number of things that we can take from this, but I think the most important is to understand that trading options is very different from understanding options. Anybody can say, here's what I think the stock is going to do, let me go do this strategy. I think the stock is going to sit still, let me do a butterfly. you're going to have limited success at best, at very best. But if you understand why you're making the moves as if it's a chessboard, there's a whole different level of understanding and therefore much better chances for success. So if you find these little tips and tune-ups helpful and interesting, imagine what a coaching call could do when it is tailored, custom tailored to your needs. So we're inviting you to take advantage of this offer. It's a free 30-minute one-on-one consultation with one of our world-class coaches. The phone number is 888-809-8058. And please give them a call, have a chat with them, say, here's what I'm trying to do, here's my goals. What are some ideas you can give me? And you'd be surprised what a floor trader with 30 years of experience can tell you of the things that you just didn't even know you didn't know. And that's where you're going to start to make bigger progress. So again, I hope that helps. And we hope to see you on Thursday and Friday of this week. We're going to talk a lot about different hedging strategies and interesting things about the market. And so again, I hope that helps everybody, and we'll look for you on Thursday. Thanks so much.